Okay, so we are recording. I see some questions. They do all lectures in the 20th of April. Well, I know that our last lecture is next week Tuesday, and you're writing on Thursday, if I remember correctly. So I'm sure that that is then the last day of lectures. So yeah. So, but yeah, it will definitely be for all 4 modules. I doubt if, well, you in any way don't have lectures on Wednesday. So yeah, so Tuesday will be your last lectures before the year test start. Good. Okay. Mr. Fisher says I could just go ahead and swear in front of everyone. I know, and I used to do that, but some people don't like it. So, not that I worry about what they think, but I don't want to alienate people unnecessarily. So that's why I thought I'll rather just stop swearing completely. So, but I'm taking it one word at a time. So, yeah, we'll see how it goes. I'll let you know. Okay, so today is our 4th lecture for IFRS 16. And we started yesterday with the lessor, and we spoke about the classification between the finance, a finance lease and an operating lease. And I asked you to go and have a look at that example, that discussion example, just to see how you will go about discussing a discussion question on deciding on which type of lease, how to classify leases, which type of lease to classify, a lease transaction. Good, so today, what we are doing, so that was the classification. We've now looked at the classification, finance versus operating. So we are going to start with a finance lease. So for the lessor, we get the 2 types of leases, the finance lease and the operating lease. So we are going to look at the initial and subsequent recognition of a finance lease. Now note that we get 2 types. The standard talks about 2 types of finance lease lessors. So they talk about a manufacturer or dealer lessor. So a manufacturer or dealer lessor is a lessor that actually manufactures the asset that it leases out to a lessee, whereas a dealer lessor is someone who actually purchases that it as inventory and normally sells it at cost, or otherwise leases this asset out, this inventory asset out to lessees. So the standard talks about manufacturer or dealer, and then the standard just talks about non-manufacturer dealer lessors. So I decided to call that incidental lessor. So that's and that's mainly when I just say lessor, that's what I actually mean. So that's also what we will focus on. The manufacturer or dealer lessor in SAICA's syllabus is on a lower level than just the normal incidental lessor. So when I say lessor for a finance lease, this is what I'm actually talking about, unless I say specifically it's a manufacturer or dealer lessor. But we'll get to manufacturer or dealer lessors later. But just know when you see the word incidental, or when I speak about an incidental lessor, or you see it in your notes, the standard doesn't really talk about an incidental lessor. The standard just says that this does use the word lessor. It says that this type of lessor is someone who just incidentally enters into a lease contract. So decides they have an asset that they're not using that much, rather than just let it lie there in our storeroom, let's lease it out and at least get some income from it. So it's an incidental lease transaction. Yes, okay, so that's what we are going to be focusing on. We'll get to manufacturer dealer lessor later. Good. I see a question here. Is an installment credit agreement considered a lease, or is it just a sale with maybe some interest? Okay, installment sale agreement, that is if I remember correctly, that is a term that we get from the Income Tax Act. Am I correct? So, so you will see. Well, just Mr. Armstrong, yeah, okay. So you will see that when we do give you a leases question, or in our examples, and we do the tax, we will always tell you that this lease has been classified as a lease by the South African Revenue Services, therefore not as an installment sale agreement. So for our purposes, when we look at the tax, we will not look at installment sale agreements, the tax on that. We will look at the tax treatment of a lease. So yes, I think well, it's a little bit weird because you'll have to look at the transaction, the contract, to determine whether because if ownership transfers at the end of the lease, and you know, we'll have to look at all of those to decide, is it maybe just a financing transaction, or is it actually a finance lease transaction? So yeah, so but installment sale agreement, like I said, that's a tax term. Okay, does the manufacturer dealer always offer the option to purchase? Not necessarily, not necessarily. So like I said, we'll get manufacturer dealer later. So manufacturer dealer lessor does not, it's not necessarily that they offer that, that there's an offer to purchase the asset by the lessee at the end of the lease term. So that's not the not necessarily included in those lease transactions. Okay, and then yes, Mrs. Swanepoel, we will always look at the transaction. We'll look at the substance over form. Okay, good. So here we are here now. We're looking at a finance lease, and we're looking at the so like this is like the general rules. And then when we get to manufacturer dealer lessor, there are just some small changes, some small specific changes that applies to the manufacturer dealer lessor. But for now, let's just focus on the general rules for finance lease. Good. So initial recognition. So we are now in our standards. IFRS 16 paragraph 67 tells us how to recognize a finance lease on the commencement date, the initial recognition of the finance lease. So paragraph 67 says that at the commencement date, the lessor shall recognize assets held under a finance lease in its statement of financial possession and present them as a receivable at an amount equal to the net investment in the lease. Okay, so at the commencement lease, what happens is the lessor recognizes a net investment in the lease. So basically, the lessor is exchanging one asset for another asset, exchanging a PPE asset that was lying there in the storeroom that wasn't being used, saying, okay, I'm exchanging that now, lessee, you go and use that. And in exchange for that, I'm recognizing a net investment in the lease. So what is a net investment in the lease? If we look at the definitions in Appendix A, we see that it says that a net investment in the lease is the gross investment in the lease, okay, gross investment in the lease, discounted at the interest rate implicit in the lease. Okay, at least we know what the interest rate implicit in the lease is. But what is a gross investment in the lease? So again, in definitions, standard tells us the gross investment in the lease is the sum of all the lease payments that are still receivable by the lessor for this finance lease, plus any unguaranteed residual value accruing to the lessor. So that's our gross investment in the lease. So remember, lease payments, definition of lease payments for the lessor will include all the fixed payments, variable payments that are linked to an interest or a rate. What else is? Well, and then also the important thing, the difference between the lessee and the lessor is that this will also include the amount payable in terms of the residual. Sorry. It will actually include the total residual value guarantee. So the lessee includes the amount payable in terms of the residual value guarantee, where the lessor includes the total amount of the residual value guarantee. And then we also add the unguaranteed residual value to that. In other words, in the end, the gross investment in the lease is all the cash that I'm going to get over the lease term, as well as the total value that I'm going to get at the end of the lease term, and that I recognize as my gross investment in the lease. Okay. So how it works, how we account for this net, we have to now account for this net investment in the lease, recognize a net investment in the lease. How do we do that? Well, we do that by using two T accounts, two general ledger accounts. The first one is my gross investment in the lease, and the second one is our unearned finance income. Okay, so these two general ledger accounts, meaning that we do not have a general ledger account for the net investment in the lease. Okay, and this is very important. So think about it when we, for IFRS 16 PPE, we have one T account where we have our asset cost, cost at asset, you know what I mean. So the asset at cost. And then we have another T account, which will be our accumulated depreciation. Okay, so the asset at cost account will always have a debit balance, and the accumulated depreciation will have a credit balance, and the net effect of these two will give us our carrying amount of our PPE assets. Okay. We have the same thing for, well, this is actually for financial assets, where we have our debtors, our gross debtors, and we have our allowance for expected credit losses. Where the debtors will always have a debit balance, the allowance for expected credit losses will have a credit balance, and the net of these two accounts will give me my debtors balance on my SFP. Okay, so now we use that same principle for IFRS 16 when we recognize the net investment in the lease. So what we do now is we have these two GL accounts for IFRS 16. The one is the gross investment in the lease, and the other one is the unearned finance income, where the gross investment in the lease will always have a debit balance, unearned finance income will have a credit balance, and the net of these two will give me my net investment in my lease, which is the amount that goes onto my statement of financial position. Okay, so that's the principle that we follow here with our GL accounts to account for the net investment in the lease. Okay, so please, no T account, no general ledger account, no journals. You cannot do a journal to your net investment in the lease account. There is no such account. Okay, and funny, last night we were sitting at the dinner table and we were discussing, my daughter wrote a accounting test or something earlier this week, and we were discussing, because I always used to explain accounting to my son and my daughter, and my son said, oh, he just hated it. The moment when if he asked me a question and I sat down in front of him and I drew a T account, he just hated that. He hated seeing a T account. That's the worst. He can't understand why I need a T account to explain anything. But really, T accounts, guys, you have to, if you can do the journals and you can do the T accounts for any topic, you will understand that topic. So my children roll their eyes at me when I draw T accounts, but really there's no other way to understand accounting than by doing T accounts. You have to be able to see it. You have to be able to see how the accounting entries go into the T accounts and how that will affect the statement of financial positions. Okay, good. So make T account your friend. I see a question here on the chat. Zanay, Ms. Pretorius, is the gross investment in the lease an asset in the books for the lessor? Yes, it's an asset. But remember, like I said, we actually have these two accounts. So we've got the gross investment in the lease and the unearned finance income. So both of them together is our asset that we put on our SFP. Okay, so that's why I said this is almost like your accumulated depreciation or your allowance for expected credit losses. We have to look at these two accounts together to get to our asset value in our SFP, because the gross investment in the lease is exactly that. That's literally the future payments that I'm adding all the future payments together, and I'm slapping them into the gross investment in the lease. So if I just have this account on my SFP, then that's not going to give the correct picture of the asset value, because included in that gross investment in the lease is a lease payment that I'm only going to receive, say the lease is for 10 years, so I'm only going to receive that payment over 10 years or after 10 years. So if that payment is R1,000 over here, which is going to be the value at which it is included in my gross investment in the lease, that's not going to be the actual present value, the present value on the date that I am drawing up my statement of financial position. So that's why we need this unearned finance income account. Okay. Unearned finance is a negative asset. Yes, Mr. Duplessis, that's correct. Mr. Schmidt, so the lessor is different from the lessee in terms of the fact that the lessee shows the right of use asset at a net value. Depreciation goes to right of use account, but lessee will use the two gross accounts. Yes, but remember, together they give us a present value. These two accounts together give us a present value, okay, on the date. Okay, Ms. Swanepoel, I'm sorry, I see that yeah, you're having some issues there with that it's lagging. I'm glad to hear that that it's not a common problem. Hope you can sort that out. Okay. Good. So that's just so that's our initial recognition. That's the way we are going to recognize this, and we'll do a example just now to see exactly how it works. Good. So yeah, as we said, remember that your gross investment in the lease includes all your lease payments receivable. So that's literally if the lease contract says that your lease payments are R1,000 per year for 10 years, then that's literally the amount that we include in our gross investment in the lease. R1,000 times 10, 10,000 Rand. As well as if there is any unguaranteed residual value, we also include that at the gross amount. Okay, not at the present value, at the gross amount. And then we will, from that, yeah, like okay, you know, that's everything that's included in the lease payment definition for the lessor. So everything that's not yet paid or received if it's a lease incentive. And remember that we include the full residual value guarantee. Okay, so that goes into the gross investment in the lease. Now we have to deduct from that, from the gross amount, we have to deduct the unearned finance income. So that's finance income that we are still going to earn over the period of the lease. So the unearned finance income, how do we calculate that now? We calculate that using the interest rate implicit in the lease. Okay, and remember now for the lessor, we will not have an option to use the incremental borrowing rate or anything like that, because the lessor will have all of the information that is needed to calculate the interest rate implicit in the lease. Okay, so we know that the definition of interest rate implicit in the lease, it's the rate at which the present value of all the lease payments and the unguaranteed residual value will equal the fair value of the asset plus any initial direct costs of the lessor. So that's almost like it's like the lessor's return on investment. So if the lessor is giving up an asset on day one, as well as some cash for initial direct costs, and in return they are getting all these lease payments as well as that unguaranteed residual value, what is the rate of return that they are getting on this transaction? And that is our interest rate implicit in the lease. Okay, so we're going to use the gross investment in the lease. Then we're going to use the interest rate implicit in the lease to calculate what our net investment should be. And then the difference between these two is just going to be my total unearned finance income. Okay, and again, these little black circles here, that's the paragraph number. So paragraph 67 tells us how to account for this lease at initial recognition. Paragraph 68 says that we should use the interest rate implicit in the lease, and paragraph 70 just reiterates again what the lease payment amounts are that will be included. Okay, so let us look at example 9. So example 9 will show us the, or we'll do the initial recognition for a finance lease, a lessor, in example 9. So just open your notes, get your notes open in front of you like I am doing now. Cool. And then we'll look at example 9. I'll just give you a second before we do the example. Anyone else with a quick question? Okay, it seems everyone's happy so far. Okay, let's look at the initial recognition. Maybe after the example you will have some questions. Okay, so they give us a lease transaction. We are we are Cabernet Limited. Ooh. We are Cabernet Limited, so that's the lessor. The Merlot is the lessee. Okay, I don't like Cabernet or Merlot, so therefore I will call it Cabernet and Merlot. Okay, so the commencement date of the lease is the 1st of July 20x14. Oh, sorry, I just see all these chats popping up. Ms. van der Walt is asked, would a balloon payment at the end of the lease term also be included in lease payments receivable? Yes, it will, because if you think about it, it's going to be included, so that's going to be one of your fixed payments in terms of the lease contract. So if there's a balloon payment, yes, that's going to be included. Okay, because it's part of the lease payments definition. But like I said, think about it, almost put your FPS hat on. Think about return on investment. So the lessor is giving something up on day one. It's giving up the asset as well as maybe some cash for initial direct costs. What's the lessor getting in return? It's getting some lease payments in return as well as the balloon payment. And then, so obviously the balloon payment should be included in my lease payments and my gross investment in the lease. Good, okay. So commencement date is the 1st of July 2014. The Cabernet Limited is the lessor. No purchase options, extension options, or termination options. Now we see from the lease contract, we can see that the lease payments are 80,000 Rand each. So that's my payment amount for a 5-year term. So that's our N. N is 5. If the fair value of the machine at the end of the 5-year lease term is less than 15,000, Merlot Limited will pay an amount to Cabernet, calculate as the difference between the fair value and the amount of 15,000. So that is our residual value guarantee, the 15,000. The following additional information is available on the lease commencement date. Merlot, remember now Merlot is the lessee, incurred initial direct cost of 2,500 related to the lease agreement. So will the lessee initial direct costs, will the lessee initial direct costs affect the lessor? What do you think? When we did the lessee, we would have wanted to know what the lessor's initial direct costs were so that we could calculate the interest rate implicit in the lease. However, now we are the lessor. Do we worry about the lessee's initial direct costs? No. Okay. So the lessee's initial direct costs, we're just throwing it in there. We're not doing that to confuse you. We are putting it in there to give you the opportunity to show us that you know that this is not relevant to this question. Okay, so you guys always think that we are trying to trick you. We're not trying to trick you. We are giving you the opportunity to show us that you know your work. Okay. Now next bullet point, Cabernet Limited incurred initial direct cost of 1,500 related to the lease agreement that it paid in cash. So that is now the lessor's initial direct cost. So yes, we will include that in our interest rate implicit in the lease calculation. Cabernet is estimated would be able to sell the machine at the end of the 5-year period for 10,500. So this 10,500 is our residual value of the asset. Okay, but remember we had a residual value guarantee of 15,000. So we had a residual value guarantee of 15,000, but we think the residual value is only going to be 10,500. So therefore, there's a difference of 4,500. And what is that 4,500 difference going to be? Okay. So on the chat, what do you think? So residual value guarantee was 15,000, but we think the asset is only going to be worth 10,500. So the difference between the two, what is that 4,500? Yeah, so combination between Mr. Armstrong and Ms. Peters's answers there. So it will be the amount payable by the lessee in terms of the residual value guarantee. So Ms. Peters, it's not the 4,500 is not the residual value for the lessee. It's the amount payable by the lessee because of the fact that there's a residual value guarantee of 15,000. Okay, so can you see that the lessor at the end of the lease term is going to get, the lessor is going to get the asset back, which is going to be 10,500, as well as then 4,500 in cash. So that's the asset and 4,500. So the lessor is getting the full 15,000 at the end of the lease term in terms of this residual value guarantee. Okay, can the lessee and the lessor have different estimates for their residual values? Good question. In practice, I'm sure that is going to happen. I'm sure that is definitely going to be the case. However, for our purposes, for academic purposes, we will assume that these facts and these estimates, and everyone's looking into this crystal ball that they got from the same manufacturer, so they all have this, see the same estimates. So for our purposes, no, there won't be a difference. But I'm sure in practice it does happen that there are differences. Okay, because the lessor might think, oh no, this lessee is going to look after this asset very well, and whereas the lessee might actually think, oh, I'm going to really use this asset. Okay, so for our purposes, no. We are in the fortunate position that we can, as academics, we can create a perfect world the way we want to see it, and to make things a little bit easier. Not easier, but that's basically what it boils down to. Okay, so are there separate KPMG, PwC, EY, and Deloitte crystal balls? No. Remember, those firms do not issue you with your CICA, with your CASA qualification. CICA, South African Institute of Chartered Accountants, they issue you with your CA qualification, and then when you get your certificate from CICA, you also get your crystal ball. Okay, and they are all made in China, but they are very good quality crystal balls. Yes, one crystal ball manufacturer, and so, okay, I really hope CICA does not see this video, and then yeah, get cross with me for saying that they are going to give everyone a crystal ball. Okay, so we are actually that crystal ball is the knowledge that you are getting now in during your academic period, as well as then the knowledge that you are going to get, the practical experience that you're going to get from the firms, and that, so we are all actually building our own crystal balls. And hopefully they will be perfect and they will give us good answers. Okay, good. What else are they giving us? Incremental borrowing rate of Merlot. Again, I'm giving you that to give you the opportunity to show me that you know that that's irrelevant. The fair value of the machine at the inception of the lease is 300,000. So that's the fair value of the asset that the lessor is giving up, which is also the carrying amount of the machine on the commencement date, the books of the lessor. And interesting, it was purchased on the same day that it was actually leased out to the lessee, and you'll see that many times that this does happen in our questions. Okay, so now they ask us to first of all calculate the interest rate implicit in the lease. Okay, so we've already got all the information we need. We've got our payment amount, we've got our N, the 5-year terms, we've got our residual value guarantee, as well as our, total residual value guarantee. There's no unguaranteed residual value in this example now. We have our initial direct costs by the lessor. What else do we need? We have our fair value of the machine on day one. We can now go ahead and calculate our interest rate implicit in the lease. So in the suggested solution, that's exactly what we did. There we have our, and like I said, think about it with your FBS hat, your financial management hat. So the lessor is on day one is giving up an asset with a fair value of 300,000 as well as some cash. In return, they're getting the 80,000 payments for 5 years. And then at the end of the lease term, the lessor is also getting 15,000 Rand back in the form of the asset and some cash. So the lessor's return on investment, which is also our interest rate implicit in the lease, will be 11.395%. Okay, so now we've got that, and now we have to do our initial recognition for this lease. So remember what we do. We've got our two T accounts. We've got our two T accounts. So the one is our gross investment in the lease, and the other one is our unearned finance income. And in total, the net of these two amounts must give us our net investment in the lease, which is this present value that we have over here. So on day one, our net investment that we gave on day one was 301,500 Rand. So the gross investment in the lease, how we calculate that total, is we just go and add up all our lease payments for the entire lease period. And then we also have to add our residual value guarantee, which is included in the definition of a lease payment. So therefore, here we have so this will be our gross investment in the lease, the total gross amounts that I'm going to get in future. But my net investment in the lease, as we said, is this whatever I'm giving up on day one. That's the asset plus the initial direct costs. So I'm giving up 301,500, so that's our net investment in the lease. And the difference between the two will be so that's our unearned finance income. Okay. So if I have to account for that gross investment in the lease, I will debit 415,000. Unearned finance income, I'll credit with 113,500. That gives me the net of that gives me the 301,500 that I gave up. Now for my journal to balance, if we just look at the journal, let's quickly look at that journal. Here we go. So there's our gross investment in the lease, our unearned finance income. We said that the net of these two amounts is the 301,500 that we gave up on day one. So what is it that we gave up? We gave up the machine, so we have to take that out. Do you recognize the machine? And then we also paid some initial direct costs, so we credited back. Okay, so that is our journal at initial recognition. Let's see, is 2 decimals from our calculator okay? Okay, you'll see that sometimes in a question we tell you that round all calculated interest rates to 4 or 5 decimals. So if that's the case, then obviously, you know, you will be penalized for not reading the instructions properly. So therefore, yeah. If the instruction says 4 or 5 decimals, then that's what you have to do. Okay, but if the instruction does not force you to do that, then don't worry about it. And also remember that when your calculator is set to just show you 2 decimals, it still remembers all the other decimals. So when you do your amortization table, whatever the case may be, it's still going to use the full interest rate with all the decimals. Whew, okay, now opened up a can of worms here, it seems, with the calculator. Ms. Swanepoel, so it's the same calc as for the lessee interest rate implicit. Yes, exactly. Remember when we did the interest rate implicit in the lease for the lessee, we had that green eye. Remember, I showed you that there's a green eye because we calculate the interest rate implicit in the lease from the perspective of the lessor. So that's why it's the same interest rate. So again, in a perfect world, which we can create in academia with our questions and our examples. In a perfect world, these two interest rates will be the same for the lessee and the lessor, and everything will just, whatever happens in the lessee's books will be just the opposite in the lessor's books. But obviously that can't really always happen, because the lessee will not know what might not know what the initial direct costs for the lessor was, or what the unguaranteed residual value is. So therefore, for the lessee, we sometimes, and most of the time, we use the interest rate, the incremental borrowing rate for the lessee. Good, Ms. Pretorius, can you only calculate the unearned finance income as a balancing amount? Is there no other way to calculate it? Oh, good question. There is another way. There is another way to calculate that. So if you look at your calculation here of your interest rate implicit in the lease, well, maybe someone else has already answered your question. Okay. I don't see specific questions to that answer, but how you can calculate your total unearned finance income is you do this calculation on your calculator, and then you go and you say, okay, now I want, you say one input, and it's 5 years 5, and then you say amort, and then you press your enter or your equals button until you get to your interest total, and then the amount that you are going to get over there is going to be the total interest over your lease term, and that will also be your unearned finance income. Okay. Okay, so you're answering each other on how to change the display of the decimals. Good. I'm glad to see that you're helping each other there. How would the journal look if there was accumulated depreciation on the asset leased? Okay, if that was the case, then obviously in this case what happened was we purchased the machine on the same day that we started leasing the machine out. So if that was not the case, let's say for example that this machine over here actually, so the carrying amount was 300,000, which was also the fair value. Okay, but that carrying amount actually consisted of the original cost of, let's say that was 400,000 and accumulated depreciation of 100,000. Then obviously what's just going to happen is that this journal, this 300,000 over here is going to be split between, it's going to be, you're going to have a 400,000 here to your at cost and the 100,000 here for your accumulated depreciation. Okay. Yes, so as Arnold said, I don't think it would change as the fair value would include the effect of the depreciation. Yes, you're right, but remember that at the moment, before we now enter into this lease, this asset would be sitting, the balance would be sitting here, 400,000 over here, and accumulated depreciation, 100,000 over here. So if we now just do a journal of 300,000 to clear it out over here, we're still sitting with this strange balance in accumulated depreciation. Good. Okay. Okay. IS 40 question. Park that question right there. We'll get to that. Okay. So. Yeah. Okay, so what we also here, you also see the amortization table for this transaction. So remember, I told you that when you use the calculation that we did over here to calculate your interest rate implicit in the lease, and you then do your one input 5 amort interest function, then it gives you your total interest, and that's exactly also what we'll get in our amortization table. So if we do that on our calculators where we say one input 5 amort interest, then that's the total that we are going to get from our calculators. Good. Okay. Then in this question as well, okay, part E in this example. Well, before we move on to part E, any further questions or issues? I'll give you a second or two. Okay, I don't see anything. But just quickly mention on what happens in part E of this example is that now we just change the amounts a little bit. So we tell you now that let's assume that the residual value guarantee was 10,500, and that the lessor expects that the asset they will be able to sell the asset at the end of the lease term for 15,000. So we're just switching those amounts around. So what happens here is now we have a residual value guarantee of 10,500, and we have a residual value of 15,000. So the reason why we have this little adjustment in this example is just to show you now, to make sure that you understand the difference between what happens when there's an unguaranteed residual value. Because now, if the asset is going to be worth 15,000 at the end of the lease term, there's no amount payable by the lessee. So the lessee is just going to return the asset of 15,000 to the value will be 15,000 that the lessee returns the asset to the lessor. No cash that they have to pay because the residual value guarantee was lower than the residual value. But now the difference between the 10,500 and the 15,000, so now that 4,500 difference is going to be our unguaranteed residual value. Okay, so in E, now you'll see that our fair value over here still stays at 15,000, but that's now because this is now the residual value guarantee of 10,500 plus the 4,500 unguaranteed residual value. Okay. So otherwise everything stays the same. And also note that for my gross investment in the lease, we will now add our unguaranteed residual value so that we get to the 415,000. Okay. Good. So that is example 12, initial recognition. Example 9, initial recognition. How would the deposit paid by the lessee affect all these journals? Okay, so how would the deposit paid by the lessee affect the journals? So if there was now a deposit that was paid, then what's going to happen is, if you think about your see if I can get another. If you think about your interest rate implicit in the lease, so what's going to happen now is that amount that the lessee is paying on day one is actually going to decrease the present value here. So it's going to decrease the value of everything that the lessor is giving up on day one. So therefore, if there was a deposit paid, then what happens on day one is we have the we'll only take into account, let me just think about this a while, a little bit. Just think about it. Okay, so if you think about, oh gosh, I know that, yeah, okay. So there's a deposit paid by the lessee. Obviously, it's not going to be included in my gross investment in the lease, because gross investment in the lease is only the lease payments that I still am going to get in future. However, now if there's a deposit paid by the lessee, in this case, then obviously that's going to affect my interest rate implicit in the lease, because my present value on day one is going to be a smaller amount, because it's the fair value of the asset plus the initial direct costs. But then, so that's what we're giving up, but we're also receiving some cash. Okay, so that's why So that's how the deposit is going to affect these journals. Let me just think about that a while. I think we have an example a little bit later. You caught me now on the back foot. I'll just think about it and we'll get back to you. So who asked that question? Mr. van der Merwe, thank you for making me sweat so early in the morning. But I'll think about it and we'll get back to that. Okay. will affect the net investment, I think. Yes, exactly. That's Ms. Swanepoel. That's what I also said. My gut feeling was. Okay, but I'm sure we have an example later. We'll get to that. Okay, so that was initial recognition. Okay, we looked at the journals already. Okay. Now we get to subsequent measurement. So what happens with for the subsequent measurement of a lease, finance lease for the lessor? Okay, so remember now that we have these two GL accounts, the gross investment in the lease and the unearned finance income, and both of them together give us our net investment in the lease. So subsequent measurement we find in paragraph 75 to 78, where the standard tells us how to measure our finance lease subsequently, since after we've done our initial recognition. So paragraph 75 says the lessor should recognize finance income over the lease term based on a pattern reflecting a constant periodic rate of return on the lessor's net investment in the lease. And that's exactly what we are doing with our amortization table. So with our amortization table, we are calculating what the portion of the interest is that we are earning every time we are receiving a lease payment. Remember that lease payment that we are receiving consists of an interest portion and a capital portion. So that interest portion that we calculate in our amortization table gives us that constant return on our net investment. Okay, so that's how we're going to recognize the income now from the unearned finance income. The moment we earn that, as calculated by the amortization table, that's we will recognize that as finance income. Okay, then paragraph 76 says a lessor aims to allocate finance income over the lease term on a systematic and rational basis. A lessor shall apply the lease payments relating to the period against the gross investment in the lease to reduce both the principal and the unearned finance income. As we are receiving that lease payment, we are first of all going to decrease our gross investment in the lease because we are now receiving that payment. And with that payment, we have now earned some finance income. So some of that unearned finance income can now be released to the splokkie as a finance income received. Good. Okay. Just a quick note there. What happens if our reporting date and our lease payment dates are not the same? So if the lease year and the financial reporting years are not the same, what should we do then? Then what we'll have, remember we had that with the lessee as well, the moment that our financial year and our lease years do not agree, we have to have accrue for a portion of that interest. So now it's the same thing. Although we haven't received the lease payment yet, some of that interest has already been earned. And that interest that has been earned, we have to accrue for, and we don't take it to a separate interest receivable account. We just release it from our unearned finance income account. Okay, so we calculate if this was now my financial year and my lease year, last lease payment that I received was over here. That means I'm only going to receive my next lease payment over here, but some of that interest for this period, I've already earned that. So therefore, that portion of the interest must be released to finance income and taken out of unearned finance income. Okay. So we'll see that that is exactly now what happens in class example 10. So if we go to class example 10, we will see how that works. Okay. Let's see. Mammy said when we were doing, let's see, the lessor gets the wear and tear and depreciation. So how do we measure that when at start we did recognize the asset? Okay, Mr. Duplessis, you're talking about the tax treatment now that we will get to. So, and just as the just as SARS, it was irrelevant to SARS that the lessee actually recognized an asset. SARS just said, I don't care if you recognize the asset or not. In our opinion, this asset stays with the lessor. That's why I'm not giving the lessee a wear and tear allowance. Same principle applies here. Sasha's just going to say to the lessor, well, I don't care if you de-recognize the asset. This asset actually still belongs to you, therefore you are getting the wear and tear allowance. Okay, so the tax treatment is irrelevant to the accounting treatment. Okay, so question, can I just repeat paragraph 75 and 76? Okay, so basically all that paragraph 75 and 76 says is that we have to remember that we, if you think about our 2T account now, so there's our gross investment in the lease, and there's our unearned finance income. So here, let's say, so here we include all of our lease payments that we are still going to get in future. They are lying there in our gross investment in the lease. And then our unearned finance income is going to be the interest portions on all of these payments. So say we are now in 20x1, 1st of January, 1/1/20x1. So this is going to be the lease payment that we are going to get on the 31st of December, x1, x2, and x3. Now, when we do our amortization table, we said, okay, for each of these lease payments, there is an interest portion and there's a capital portion, okay? So, so if we now add up all the interest portions of all those payment amounts, let's say that was 120 Rand, for example, then that's the amount, the unearned finance income that I account for on day one. Okay. Now, what paragraph 75 and 76 says is when I receive my that lease payment, let's get another color. So when I receive the lease payment, obviously, I'm going to, in my bank account, I'm going to get that 80,000 cash. The other leg of that journal will just be to take out one of my lease payments that so now I've actually received it, so I'm clearing that out. Okay, so leaving just the two that I still have to receive in future. Now, obviously, I've also, when I received that lease payment, I've earned some of the interest already. So I'm going to have to, in my finance income account and P&L, some of that interest I have now earned. So that has to sit over here. So to get it, so that means I'm going to take it out of my unearned finance income. I have now earned it, and therefore it goes to my finance income in P&L. So that's what this paragraph 75 just says, that this unearned finance income total, we are going to release bit by bit as we earn that finance income over the lease term. We release it bit by bit to the splokkie as we earn it, okay, on a systematic basis, which comes from our amortization table. And then our gross investment in the lease, we decrease that by the actual cash that we receive from the lease payment. Okay, but we'll see that in the example just now. Okay, so in example 10, let's quickly go to example 10. So in example 10, we use the same information as in example 9. And now we do the subsequent recognition, subsequent measurement. So what now happens at the end of our lease term, or at the end of our lease year? Well, first of all, the first year that we have is 30 September 20x14. So on this date, although we entered into the lease during this financial year, we have not yet received any lease payments on this date. But for 2015, we would have received our first lease payment. So here we have our initial recognition, where we put all the total of our lease payments and our, in this case, it wasn't, so this 15,000 over here consisted of our 10,500 fair value of the asset plus the 4,500 cash that we are going to receive from the lessee. So that's that 15,000. We put all of that into our gross investment in the lease. We have our unearned finance income over here, and we've derecognized the asset and we paid some initial direct costs. If there, I'm not, see, I told you I'll think about it. So what would happen now if we had a deposit, if there was a deposit that was paid by the lessee on that day? Oh, that was not the idea. Okay, if there was a deposit paid by the lessee, then we would also have a bank journal over here to recognize that payment that was received, the deposit payment that was received. And obviously, because we've received some of that here, this is going to affect the unearned finance income because the interest rate implicit lease is going to be different. See, I told you I would remember what to do with that. Okay, but never mind, we don't have a deposit, but just if we did that, then that's what would have happened. So that was my initial recognition that we did in example 9. The subsequent measurement now, what happens is we go to our amortization table and we see, okay, now we are sitting, this is our financial year, 30 September X14. We entered into the lease agreement on the 1st of July over here, but we have not yet received the payment. However, we have earned some of the finance income. So some of this interest that will be included in my first lease payment to be received, I've earned some of that already. So therefore, we have to accrue for that interest. We have to release some of this unearned finance income we have now earned. So we have to calculate what it is and release it so that it can go and play with its friends in the splokkie in finance income. So we take this interest amount, the 34357, which remember is now interest for 12 months, but we only earned July, August, September, we only earned 3 months worth of that interest. So we take the 34357, multiply it by 3 over 12, and we say, okay, you guys from unearned finance income, we open the gate, you can go and play in P&L. We release you. We have actually earned that amount of unearned finance income. Okay. Good. And then, so what happens now in the next financial year when the lease payment is actually received? Now we go and we say, okay, we received the 80,000. And the other leg of that journal is now the 80,000, the first 80,000 payment that we have now actually received. So we take that out of our gross investment in the lease. So remember, our gross investment in the lease over here, the 415, included all of my lease payments as well as my residual value guarantee at the end. So now we just say, okay, this first one we have now received, so we clear that out by crediting the gross investment in the lease and debiting bank. And then we say, okay, but for that payment, remember, we've already accrued for some of that interest, so the remaining interest we also now have to release so that it can go and play in the P&L. So this 25768 over here and the 8589 over here together make up the 34357. So it's just split between two periods. Okay, so that is then the, and then the same happens again at the end of the next financial year. Now again, we have to say, okay, payment 2, the interest portion of payment 2, some of that we've earned already, we have to accrue for that, and and we accrue for that by releasing it from unearned finance income, and the rest we'll only earn next year. Okay, let's quickly check the chats over here. Let me just quickly check time. So the answer to that, sorry, I was reconnecting at that time. Okay, so I think they have answered you there, Mr. Tsetsi, about the unearned finance income, how to calculate that. Thank you, guys. Okay, cool. Let's see if there are any other questions that I have missed. Maybe if you posted a question and yeah, I know. I'm just thinking of a way to save us time so that I don't have to actually read questions that you guys have already answered for each other. But we'll think of a plan. Is the unearned finance income an asset account? Yes, remember that's like it's like a negative asset. So unearned, because we are accounting for my net investment in the lease with these two accounts, the gross investment in the lease gross investment and the unearned finance income. This is the gross amounts, the 80,000 that I'm going to get in future. Unearned finance income is then the finance income that I still have to earn. So the net of that will give me my asset, my net investment in the lease. So it's almost like a negative asset. Good. Okay, don't see any further questions there. Okay, so that's subsequent measurement. So the deposit element in the initial journal again. Okay, let's see if I can find a clean journal. Yes. Okay, so if there was a deposit paid by the lessee, then what would have happened in this journal of ours is, so here's our initial direct cost that the lessor paid. But on day one as well, what would have happened was we would have also had a deposit amount that we received. If there was a deposit amount that we would have received. So let's say there was 100,000 deposit that we have received. So obviously now the gross investment in the lease is still the future lease payments that we are going to receive. The fair value of the machine and the value at which I de-recognize that, it will stay the same. This is still my initial costs. So now what's going to change is this amount is going to change. The unearned finance income amount is going to change. Because think about it now, like we said, the interest rate implicit in the lease is like the rate of return for the lessor. So if there was now a deposit received, then what would have happened was the lessor would have on day one given up an asset as well as some cash, but the lessor would have also received some cash. So therefore, the amount that the lessor gave up on day one would actually be smaller if there was a deposit that was paid. So then obviously my interest rate is going to change. Okay, so then the lessor's return on that investment is actually going to be bigger because on day one they actually didn't have to give up as much. The amount that they have to, the net amount that was given up on day one was actually smaller. So then the interest rate implicit in the lease is going to change, which is going to change my unearned finance income. Good, cool. Woo. Sounds like feels like a marathon session this morning. So that was now example 10, where we look at the subsequent measurement. Good. Now, what happens when we have a change in the interest rate? So remember yesterday when we spoke about the lessee, we said that what would happen if my my interest rate implicit in the contract, so the interest rate that the lessor wants to, return on investment that the lessor wants to get from this asset is linked to a floating interest rate. What will happen if that's the case? So now for the lessee, the standard gives us some indication there. Remember, it said that when there's a change in the lease payment because of a floating interest rate, then you have to use the new interest rate, etc., etc. But for the lessor, IFRS 16 actually is quiet about what should happen when there's a change in the interest rate because it's linked to a floating interest rate. However, the same principles apply. So what happens here, same as what we did with the lessee, is we're saying that because my future lease payments are going to change, because the interest rate implicit in the lease is going to change. That means that the amount that's outstanding today does not change. So the net investment on the lease, the balance of that net investment in the lease, on the day that this interest rate changes, that balance remains unchanged. However, now my lease payments, my future lease payments are going to change. And because the interest rate has changed, obviously my unearned finance income is also going to change. But the net effect of these two changes is going to be zero. So net investment in the lease does not change, but we will have to fix our gross investment and our unearned finance income accounts. Good. So that's what happens in example 11. Okay, so if we go to example 11, we use the same amortization table, same transaction that we did, for example, 9 and 10. And then they tell us that assume the interest rate implicit in the lease is linked to the prime lending rate. On the commencement date, the prime lending rate was 11.395. Okay. Then on the 1st of July 2016, the prime lending rate now changes to 13.5%. So over here, we now have so here we had our old rate, now the rate changes, we have a new rate. Okay, which means that we will have to redo our amortization table for this period. Okay, so calculate the new amount following the change in the interest rate, the new payment amount, and then we have to do the new amortization table. Okay, so what we do first of all, so on this day, we say that on this day the interest rate has changed. So this was the balance of my net investment in the lease on the day that the interest rate has changed. So so that means that on this day, we would still have all these lease payments in my gross investment in the lease, and all these interest amounts, the total of that will be my unearned finance income. Okay, so that's the balances that we will still have in our those two general ledger accounts to end up with our net investment of 205,013. Good. So that's what we have at the moment in our T accounts. So in our gross investment in the lease, we will have these amounts sitting there. And for our unearned finance income, we have these amounts sitting on the credit side. And together, these two make up the balance, give us this balance of 205,013, which is the outstanding balance on the date that the interest rate changes. So now the interest rate changes. So now when the rate changes, obviously the payment amount is also going to change. So, so what we do to calculate the new payment amount, we say, first of all, remember that my outstanding amount does not change. The present value, the 205,013, the amount that I owe, or that the lessee owes me, net amount that the lessee owes me on this day does not change because of the fact that the interest rate changes. So the present value stays the 205,013. So that 205,013 is what we got from our amortization table here, 205,013. The future values is still the 15,000, which is the residual value guarantee. Our remaining lease term is 3 years. There's only 3 years remaining of this lease term. And we have our new lease, interest rate implicit in the lease. That's linked to the prime lending rate. And that gives us now our new payment amount. Okay. So now when we do our amortization table, and remember, this is the I saw the question there, would you have to do an amortization table in a test? Yes, you do, but remember you do that with your calculator. So this is the calculator amortization table that we just split for you to show you what these future amounts will be. So, but you having to write out the total amortization table, yes, that takes a lot of time. We might ask it, but it will be weird. Okay, so here we do our amortization table now for the remainder of the lease. There's our new lease payments as well as our residual value guarantee. So this balance over here is what we want our new total to be in our gross investment in the lease. Okay. That's what we want our total to be now in our gross investment in the lease. And this total over here is what we want our total now to be for our unearned finance income. Okay. But you will now see that when we do that, when we fix our gross investment in the lease total and our unearned finance income total, that the amount that we fix it with will be the same. So therefore the total net investment does not change. So this stays our total net investment balance on the date of the change. So the only difference is we have to, because our lease payments have now increased, we will have to put some extra money, or we'll have to increase our gross investment in the lease, and then our unearned finance income is also going to increase. Good, and that's exactly what we do now with this journal over here. So originally, before the change in the interest rate, our lease payments were 80,000, and we had 3 payments remaining. And then we also had the 15,000 that was part of our gross investment in the lease. And that has now changed to 3 payments remaining of 83184 for the 3 years remaining. But we also have our 15,000 that's still included in here. So the change, the difference between the two balances will be 9552 that we have to fix. And you'll see that that's also this 9552 will also be the difference between the 59539 over here and the unearned finance income balance that we still had remaining before the change in the rate. Okay. Just quickly check the time. Good. Is everyone happy with that? Does that make sense? Okay, I see some questions here. Okay, cool. I see yes, yes, yes. Everyone happy? Well, I don't know if that's a yes, you have questions, or yes, you are happy. Okay. Okay, so back to our PowerPoint then. I just want to make sure that I'm happy with this. So when we have a change in the interest rate, because our interest rate is going to change, so the interest rate changes, therefore the payment amount is also going to change. But the total net investment balance does not change. But we still have to fix the gross investment and the unearned finance income totals. If we want to end the lecture, oh shame, Mr. Makusi, are you bored? Are you tired? It has been a long week now. Yes, it's the exact same treatment as a change in the rate of the lessee. Obviously, just now we have these funny accounts. We have our gross investment and our unearned finance income. But because remember that what we did for the lessee, on the date of the change, we didn't have to do a journal. We only, at the end of the year when we had the new lease payment, we used the new lease payment amount. But for the lessor, we do have a journal on the day of the change. Good. I am boring Mr. Makusi, so let us see. We've still got another 15 minutes left. So there's still a lot of time. Okay. So, okay, we've done this. Okay, so just some quick theory. Now that we have to look at, and then one more example, but that will also be quick. So just know that because this net investment in the lease is actually it's actually a financial asset, but we account for it in terms of IFRS 16. However, we should take the requirements from IFRS 9 financial instruments into account when we have any impairments. When there's any impairments or when we have to de-recognize that, then we have to take that into account. And all this basically means, this de-recognition, that is our, we do that with our amortization table and as a financial asset at amortized cost. That's how we actually de-recognize that asset. So it's accounted for in terms of IFRS 16, but the principles are the same as for IFRS 9 financial asset at amortized cost. Okay, and then also in paragraph 77, they say that the lessor shall review the unguaranteed residual value regularly. So every year, like with all assets, we have to review what is our residual value going to be, and then if it's a lessor, then what is the unguaranteed residual value? What is the portion of the residual value that's going to be higher than the residual value guarantee? Then what's interesting here, so that's a little bit a funny thing in paragraph 77 that's a little bit different from what we know, is paragraph 77 says that if there has been a reduction in the estimated unguaranteed residual value, then the lessor shall revise the income allocation over the lease term and recognize immediately any reduction in respect of the amounts accrued. So why is this funny? First of all, paragraph 77 tells us that if our unguaranteed residual value goes up, we don't have to worry about it. Okay, don't worry about it. If it goes up, then that's fine. Then that's good. We'll get the benefit in the future. We only have to worry about when it goes down. Okay, which is weird because this is actually a little bit, it's not in line with the conceptual framework that talks about neutrality, that we should be neutral for positive and negative amounts. So this is actually a little bit more of a prudent requirement to say we only worry about the unguaranteed residual value if it goes down. Okay, so that's the first weird thing, that only when it goes down we worry about it. If it goes up, we don't do any journals or don't do any changes. The second weird thing is that it says that we should revise the income allocation over the lease term. So that is the total lease term from the start, as if this lower unguaranteed residual value has always been the case from the start of this lease. So we revise it over the total lease term, so not to the remaining lease term. Okay, so that's the second thing that makes this a little bit different from everything that we've done before. So in all the other, the lessee reassessments and everything, we looked at the remaining lease term, where here we actually are going to look at, we have to do our calculations, calculate what would the balance have been if this was the case from the start of the lease term. Okay, so Mr. Makusi, I know you're tired, but did you get that? Did you see that we've got these two differences here when we get to the change in the unguaranteed residual value for a lessor? Okay, so we only have to account for the decrease, and we have to do our new amortization table from the start of the agreement, as if this unguaranteed residual value has always been the new amount. And then we calculate what our balances should be, and then we adjust that. Good. So, and remember also that this will be an IFRS 8 change in estimate and have to be accounted for accordingly. Okay, so and that's what we find in our example 12. So that's our last example that we are doing for today. So please stay awake, clap your hands, stamp your feet, make sure that you are awake for this last example that we are doing for today's lecture. Good, example 12. Let's go to example 12. Okay, so here they provide us with an amortization table, and they tell us that originally the unguaranteed residual value was 10,500, and then there was also there's a 15,000 balloon payment as well. So the 15,000 is a balloon payment. So in this case, there's no residual value guarantee. There's a 15,000 balloon payment that the lessee has to make at the end of the lease term. And then at the start of the lease term, the lessor said, oh, I think I'm going to be able to sell this asset for 10,500 at the end of this lease. So there we have our unguaranteed residual value. And this 15,000 here is our balloon payment that we are getting from the lessee. Good. Now, on the 1st of July X16, the lessor estimated that the amount that it received from the sale of the machine at the end of the lease term is now only 6,500. So our unguaranteed residual value has now decreased, which we know, okay, it's decreased, we have to account for that. If it increased, we didn't have to worry about it, but it's decreased, so we have to account for that. Good. So that's on the 1st of July X16. So that means that we've come up to here in our amortization table, and now our residual value, unguaranteed residual value changes. Okay. So now we have to calculate the new interest rate implicit in the lease. So at the moment now, what we have is we still have all these amounts over here will form part of my my gross investment in the lease, the balance at the moment, and all these amounts over here will be my unearned finance income total on the date on the 30th of June 2016. Good. Now everything changes because now we have this new future value, which is the 6,500 guaranteed residual value. That has now changed. It was 10,500, now it's 6,500. So that gives us a new interest rate implicit in the lease. So what we now have to do is we have to do our amortization table from the start. So obviously the installments, the lease payments will stay the same, but now our interest amounts are going to change, and because of the fact that we have this new unguaranteed residual value. So we do our amortization table from the start, and then we see, okay, based on this new amortization table, this should be my balance for my net investment in the lease, whereas at the moment, my total net investment in the lease is sitting at 209. Okay. So we have to fix that. We have to fix that balance of my net investment in the lease. How do we do that? Okay, so first of all, what we have to fix is for my gross investment in the lease. These amounts are the same in both amortization tables, and the 15,000 is the same, that stays the same. But remember, included in my gross investment in the lease is also my unguaranteed residual value. So originally in my gross investment in the lease, I had the 10,500 unguaranteed residual value. Now we only have 6,500. So we have to decrease the gross investment in the lease. And then we have to fix our unearned finance income. So we have to go and calculate what should the balance now be in my unearned finance income versus what is the balance that I have at the moment. So we have to fix that. We see that, okay, that means we have to decrease the unearned finance income with the difference. And then the net amount just goes to finance income. Okay, so we don't have to. So this isn't a prior period error or anything like that where we have to go back and fix the prior years. We do that catch up in the current year. We just we do our calculation. We see, okay, this is what the balances should be. We fix our balances to what it should be, and then we calculate, and then the difference is just a catch up amount that we put into finance income. Okay, so. So that's basically all. So the thing is just we do our amortization table now just from the start, but we don't have to go and fix our finance income from prior years or anything like that. Okay, good. So that's basically it. That's basically what happens when we have a change in our unguaranteed residual value. And now continuing the year, now we'll just use our new amortization or the new numbers that we have in our financial calculators based on this amortization table. So when we receive the next next lease payment, then this is going to be the unearned finance income that I can release, so it can go and play in profit or loss, and we just continue the normal way. Okay, yeah, so here we have some long explanations of how did we get to the change in the gross investment in the lease, but basically the only change was the change between the 6,500, which is the new unguaranteed residual value, and the 10,500. All the other amounts stayed the same. What else can I tell you here? Go and look at this example. It gives a nice detailed explanation of everything. I just want to point out something specific to you that I don't know if you have noticed this, but you will see that for with finance income now for the lessor, we don't just put it to finance income, we put it to other finance income. And you also, when you look at the first set of notes that you got, which had this example of the financial statements, you will see that we had finance costs, and we had other finance income. So don't worry about that too much. When you get your IFRS 9 lectures a bit later in the year, Dr. Barnos will explain that to you, but it's basically just an IS1 requirement now that we have to split our finance income between two different types of finance income, and we have to specify specific finance income that you will learn about in IFRS 9 later in the year, and the other finance income just goes to an account called other finance income. So just note that for now. Okay, good. Let's see. Some questions here on the chats. Do you have to adjust the amount? Okay, I've answered Mr. De Jager's question. Ms. Marie, how would we account for an increase in the residual value? We ignore it. Exactly. Ms. Answer was correct. Remember, the standard said, we go to that paragraph 77, said only have to worry about a reduction in the estimated unguaranteed residual value. Okay, so we don't, if it increases, then it's good. We know that it increased, but we're not going to do any accounting entries for that. Okay, so do we do absolutely nothing with it? Yes. We celebrate it, but we don't account for it. And that's not what I said, that's what the standard tells us, paragraph 77, IFRS 16, paragraph 77. So I just think it's like a prudence. It's being a little bit prudent about that. Okay. Another question here. Why do we now add the unguaranteed residual value in this example, but the other examples we only used the 15,000 and did not add the 10,500? Okay. This example is not, the amounts are not the same as for the previous examples. Remember, in this example, what happens was they told us that now the 15,000 is a balloon payment, and then the full 10,500 is an unguaranteed residual value. So for example 12, there is no residual value guarantee. Okay, so the amounts are the same, but what those amounts represent are different. So good. So in the other examples, we only used the 15,000, did not add, because in the other examples, what happened was the 10,500 was part of the 15,000. So in this example, we are actually now, we've got the 15,000, and then we're saying no, now it's a balloon payment, and the unguaranteed residual value is an additional amount. So just watch out for that. The amounts are the same, but they don't represent the same things in these two examples. So that's also why example 12 does not say use the same information from example 9. It's completely different. Good. Next question. Since CEVs happen and with year tests coming, I think the depreciation on students need to increase, maybe reduce the residual value. Yes, but I think you have to make sure that your residual value does not decrease before the year tests are coming. So therefore, I think you should just make sure that there's no impairment. Okay, good. Okay. Yes. Okay. So Mr. Armstrong has answered one of the other questions. We need to raise a provision for burnout. No, you cannot raise that provision because the burnout is not an option for the next month or so. So do not even give yourself that option. We are just carrying on and not feeling sorry for ourselves, doing what we have to do and getting through it. Okay, so let's just quickly check our time. Yeah, our time is up, so perfect timing. See if I have some, what else did I want to mention to you here? Okay, no, we'll get to the disclosure later. I think I couldn't open up my, I had to open up an older version of my PowerPoint presentation, but I think your homework question, the one that you can do, so question 7, if I remember correctly, and yeah, to start preparing for your year test. So that's the other thing. Okay. Good. We have we don't have another minute, but yeah, I think with the year, you still have another. So you're welcome now if you want to leave and leave the session. You can do that so long, but there's just quickly something that I feel I should discuss with you, especially now with the year tests coming up. Someone mentioned this week, I read someone said something about we should help students find their purpose in life, and it's so important to find your purpose in life and all of that. And I just feel I want to talk to you guys about that, because I think especially now before year tests, if things are not going the way that you want it to go, you might be feeling, oh, but I don't know if this is my purpose, and should I be doing this, or should I maybe not be, maybe I should rather be doing something different. I remember when I was in third year, I just wanted to be a hairdresser. So I wanted to leave everything and become a hairdresser, which is weird because I literally, I think I brushed my hair this morning. I don't often do that, but I'm not that big into hair, but for some reason I just wanted to escape BCom accounting. So, and the thing is, I don't like that whole discussion, that whole feeling that you feel that you have to have a purpose in your life. Because I think many times students feel, or we all think, not just students, we all think that we are here and this purpose in our life is something outside of us, something that we have to go and look for, that's outside, that's still waiting for us in the future. And maybe what happens if we miss that purpose and we walk this way and the purpose is actually that way. And it's just so sad to me. I don't think you should think about your purpose in life that way. I think you should think about finding your purpose in your everyday life. So maybe your purpose today is to open a window for a bird that got trapped in your house or something like that. So I don't believe that we should be trying to find this big purpose for our lives outside. One day we're going to fulfill this perfect thing. You should find your purpose every day in everything that you do. So don't worry too much about what's going to happen in the future. Am I on the right track? That's what I said now with regards to the burnout. You don't have burnout is not an option at the moment. You are here, you are stuck here. You cannot think about, but should I be doing this? Should I be studying? Yes, you should. There's no other option. This is where you are now. This is the opportunity that you have in front of you. You have to give it your all. And so you don't have another choice. So find your purpose in the small things for every day, and not don't worry about too much about this big purpose lying and waiting for you somewhere in the future. And on that, one of my favorite books, if you want to read that, is The Alchemist by Paulo Coelho. So that's a very nice book to just show you that, yes, there's this big purpose, but if you just, instead of chasing the purpose, you just chase the opportunities, then you will actually one day live a meaningful and fulfilling life. Okay, so I'm going to post that the book here. So when you want to take a break from studying, you can read it. I think it's very important to read and keep on reading. So that's my book of the month that I would suggest that you read. But other than that, that's all from my side. We'll talk again next week, but you guys are now starting with your prep for the year test, so good luck with that. But I will see you again on Monday. Okay, so have a good weekend.